Good morning, everyone. My name is Vinay Navani. I'm a partner at Wilkin Guttenplan. I'd like to welcome you to our 2010 Business Tax Update. Joining me is Karen Schermacher, another partner in the tax department. And we're going to spend the next hour going through some of the most relevant developments in business tax issues that happened this year that have a special impact on closely held businesses. Now, our crystal ball for today was off by one day because we have the new Tax Act coming up, which is the Tax Relief, Unemployment Insurance Reauthorization and Job Creation Act of 2010, which is a mouthful to say, and we're just going to refer to it as the 2010 Tax Relief Act. Now, the status of this act is it was passed by the Senate yesterday. There is a House vote expected today, and very unusual for tax legislation. Both the House and the Senate seem to be in agreement because they did most of their negotiations before this got to the floor of the two bodies, with one exception. The one exception is in the area of estate taxes. So we'll talk about that issue when we get there. But let's talk about the mainstay of this Tax Act that was all over the news, which was the Bush tax cuts, which came into place in 2001 and 2003 and extended for 2 more years. And what that means is that the top individual ordinary income rate remains intact at 35%, and long-term capital gains rate and qualified dividends continue to be taxed at 15%. So what this means is that instead of having the spike to 39.6% that we were expecting if Congress did not act, we preserved the maximum rate at 35%. And as far as the 15% rate goes, for any corporations, there's C corporations that have dividends that they need to pull out of that corporation. There's an extension of that window of time to do that at a favorable rate, because before the qualified dividend rate came into play, dividends obviously were taxed at ordinary income rates, and especially for many of our S corporations that had previously been C corporations, it was always a trap, or there was always this varied amount of income that couldn't be distributed other than at the highest tax rate. So that is what we expected. But what was a surprise was there was a lot more in this act than many people thought. And the most significant one is the capital investment provisions. Really, ever since 2001, there have been year-by-year changes in capital investment incentives in the form of bonus depreciation in Section 179, which we'll be talking about a lot today. But never in our history have we had a provision that allowed 100% expensing without any sort of limits. And that's what we have in this new act. We have for assets placed in service after September 8th, 2010, up until the end of next year, December 31st, 2011, 100% bonus depreciation on assets placed in service. So what that means is, you know, if I go out and spend $500,000 on computer equipment or servers or you know, whatever that fixed assets are, generally tangible personal property, I can deduct those 100% against my income for that year. There's no need to depreciate it over time. There's no income limitations like there are with Section 179, which we'll talk about later. So this is really unprecedented. And then Congress was a little bit forward-thinking here, and they did tell us what's going to happen after December 31st, 2011. And we're going to go back to the 50% bonus, which is something we've had for the most part since 2001. It gets extended year after year as Congress tries to incentivize businesses to invest in capital spending. Now, the counterpart to bonus depreciation is something we call Section 179 expense. Section 179 expense has been in the tax code for a long time, originally designed to help smaller businesses expense a more nominal amount of fixed asset purchases, and it's grown over time. And after 2011, the Section 179 expense is going to be increased to $125,000, and what that means is up to 100. A business can spend up to $125,000 and expense that entire amount, and amounts over that have to be depreciated under the normal rules. Now, Karen's going to talk a lot more about 179 later, so I'm not going to get into it in too much detail at this time. Another area that was a surprise was the change in the estate and gift area. In 2010, as most of you probably know, there was no estate tax. This was something that was put into place in the Bush era, that 2010 was the year heralded there would be no estate tax, and in fact there was no estate tax in 2010. But the other side to it was that by December 31st, 2010, we went back to the rules as they were in 2001, which meant if you had up to $1 million, anything over $1 million was subject to a 55% tax rate. So we went from one extreme to another. So the compromise that we have now is that the exemption is set as $5 million per person. So a person can die with up to $5 million of assets and not pay any estate tax. And there's a unique provision that allows a unification of the estate tax exemption per couple. So if a husband dies with only, if a husband dies with an $8 million estate and leaves it all to his wife, generally there's no estate tax on the death of the first spouse if everything goes to the surviving spouse. Well, in that case, without getting too technical here, there's a loss of benefit, meaning that that first spouse who died could have given his unified credit amount to the second spouse without, I'm going in the bad direction here. So we leave it to say that there's some great changes here. The top rate is 35%. It's effective for the next 2 years, January 1st, 2010 through 2012. Now, this is the one area where the House disagrees. What the House wants is they want a $3.5 million exemption and a 45% rate. So that's the one area of this provision that's still subject to debate, and there might be some changes. Some other provisions, the unemployment insurance benefits have been extended for an additional year. That was an item that was in the news a lot. There is a temporary Social Security tax cut. So what has happened here is for the employee share of FICA has been cut by 2% for 2011. So as you know, there's an employer piece to FICA and an employee piece to FICA. This temporary cut applies only to the employee aspect of FICA. It has no impact to the employer. So again, this was something that most people were not predicting. In addition, there are a host of other provisions that were just simply extended that were scheduled to expire as of December 31st, 2010. Some of the ones that are more business related I've listed on the screen, but there's really a lot of items in there at that point. So that's really it for the update on the 2010 Tax Relief Act. The biggest items are going to be the extension of the capital gains rate and ordinary income rate, and we just have to keep our eyes on what the House does today and how it ultimately comes out. And I think with that, I think we have a polling question right now to make sure that everybody's still paying attention and qualifies for CPE. So it is important that you do respond to these polling questions. And it should be on your screen now. And the votes are coming in. But if you haven't voted yet, please hurry up and vote. And like I said, it is important that you vote if you are doing this for CPU credit. Okay, we're going to cut it off in a few seconds here. And of course, the answer is 15%. That's the new long-term capital gain rate that's been extended for 2 years.
Good morning. My name is Karen Schermacher. As Vinay said earlier, I'm a tax partner with the firm, and I'm going to be speaking a lot about some of the capital investment provisions that were built into the Small Business Jobs Act that was passed earlier in this year. Typically, businesses spend a lot of money investing in capital assets. And depending on the type of business you're operating, it could be machinery and equipment, it could just be office furniture, computers, leasehold improvements, and software, things like that. Under the Internal Revenue Code, many of the expenditures made by a business, whether they're capital in nature or just ordinary operating expenses, are generally deductible in the year that they're incurred. However, with the majority of the Internal Revenue Code, there's a lot of exceptions to this general rule. And one of the exceptions deals with money spent or how a business can deduct to recover the cost of capital assets. And as Vinay had mentioned earlier, typically fixed asset additions are generally recovered over a period of years through depreciation deductions. The amount of the permissible annual deduction depends upon the type of the asset that's placed in service. And the IRS has issued guidelines indicating the period over which an asset's cost is to be depreciated. However, as I just said, with all rules, there's exceptions. And Section 179 of the Internal Revenue Code provides an attractive alternative to the general depreciation rules, whereby a business can elect to deduct all or part of the cost of a fixed asset in the year of acquisition, provided that asset is placed in service during that tax year. Now, historically, this provision only applied to tangible personal property, such as machinery, office furniture, computers, and the like. However, with the passage of the Small Business Jobs Act, this provision was modified to include certain realty. And I'll just get into what realty is included in a little while. Now, as Vinay had mentioned earlier as well, the Section 179 provision has been in the code for a long time, and the maximum amount of expense available to businesses has varied over the years and has increased. It started off, I think it was $25,000 many, many years ago, and has since most recently gone up as high as $250,000. Prior to the Small Business Jobs Act, the maximum Section 179 expense is scheduled to drop back to $25,000 per year. However, there's a phase-out built in, which I'll get into. Under the Small Business Jobs Act, the tax years beginning in 2010 and 2011, the maximum Section 179 expense is $500,000. Now, the phase-out basically says that since this deduction is geared towards smaller businesses, you're going to take a company like IBM, who's going to place in service millions and millions of dollars in fixed assets every year. There's limitations, and the provision wasn't designed to benefit an IBM. It was designed to benefit closely held businesses. So to the extent a company places assets in service over a certain dollar amount, the availability of this 179 expense is limited. So the limitation is phased out. This $500,000 179 expense is phased out on a dollar-for-dollar basis, where total fixed assets placed in service during the year exceed $2 million. So in other words, if a company goes out and spends $1.5 million on qualifying fixed asset additions, they're going to be entitled to expense $500,000. However, if they place in service $2.2 million, that $500,000 maximum deduction is going to be reduced by $200,000. New Jersey, for those businesses in New Jersey does not follow these provisions at all, and the maximum expense that's allowed for New Jersey tax purposes is $25,000.
And Karen, let me interrupt you on that point. When we talk about the bonus depreciation, the Section 179 depreciation, we're talking about it for federal purposes. One of the things that makes life complicated is that most states do not conform to both these rules, and especially for a company that is working in many states, you'll frequently find yourself keeping multiple set of depreciation books to be in compliance with states that that adhere to these provisions in different degrees. So it's just something else to keep in mind, that you may get all this benefit for the federal government, but you will not get it on your state return.
Okay, good point. Okay, so basically where we are right now with Section 179 is, just to summarize, for 2010 and 2011, the maximum available deduction is $500,000, and the phase-out threshold begins at $2 million. And just to reiterate, the 2010 Tax Relief Act, for tax years beginning in 2012, the deduction is scheduled to drop down to $125,000, with the phase-out threshold beginning at $500,000. The good news with this provision is that they're retroactive to the beginning of 2010. So, if you already spent money early in the year before the passage of either one of these acts this year, you will still benefit from the increased limits. And to the extent that you're making estimated tax payments, you might want to reconsider recomputing your fourth quarter payment. Hopefully you'll be able to reduce it if you haven't already done so. Now, as I stated earlier, this provision typically or historically only applied to tangible personal property. However, with the passage of the Small Business Jobs Act, for tax years beginning in 2010 and 2011, the $500,000 maximum expense can include up to $250,000 of qualified real property. So what do they mean by qualified real property? It covers three things: qualified leasehold improvement property, qualified restaurant property, or qualified retail improvement property. Sorry. Qualified leasehold improvement property are improvements made to non-residential property pursuant to a lease. They can be made by either the lessee or the lessor. The improved portion of the building must be occupied exclusively by the lessee, and the building to which the improvements are made has to be more than 3 years old. So if you're in the process of building a facility, any improvements that you make to that facility will not qualify because the building must be more than 3 years old. Qualified leasehold improvement property does not include money spent enlarging your building, doesn't include elevator or escalator improvements, doesn't include any money spent on structural components benefiting a common area, and that, just to go back, the improved portion has to be occupied exclusively by the lessee. So, bathrooms in a hallway in a building probably wouldn't, that's not going to qualify. Additionally, it doesn't include any money spent working on the internal structural framework of the building. And one other provision when you're dealing with qualified leasehold improvements, if you have a lease with a related party, that will disqualify any improvements that are made. So if you rent a building to a sister company or a related entity, you're not going to get the favorable treatment. Qualified.
So let me just, I guess I had a point that the most common application of this would be if you're moving into a new office space and you incur, build-out costs to rearrange or redesign the space for your company's needs. That should fit into this this provision and work well. Okay.
Qualified restaurant property is simply it's a building or an improvement to a building if more than 50% of the building's square footage is devoted to the preparation and seating for on-premise consumption of prepared meals. So if you're improving, I'm trying to think of a place that wouldn't qualify, like a Dunkin' Donuts at a gas station or something where there's no place to sit down and eat, that would not qualify. A qualified retail improvement property is any improvement to an interior portion of a building if that portion is open to the general public, is used in retail, trade, or business of selling tangible personal property to the general public. And this also has that 3-year requirement that the building must be more than 3 years old. Okay. Now, as with every good thing, there's got to be something bad. So Section 179, despite the fact that it's an attractive provision, there's certain limitations which may prevent the business from taking advantage of it or benefiting from it. And the major limitation is that the company must have taxable income in order to take advantage of Section 179. So you have to look at what your taxable income is before calculating your Section 179 expense. Now again, it gets kind of confusing because regular depreciation deductions are deductible without any limit. However, when you're looking at what your available Section 179 expense is, you want to try to do it after you've calculated depreciation expense for assets that were placed in service previously, and kind of hold off on calculating depreciation on current year additions to see whether or not you can benefit from the 179. So if you end up at that point with a taxable loss, you're not going to be eligible to take a 179 expense. So if you have taxable income, however, you can elect, as I said earlier, this is an electable provision. You can elect to expense up to 100% of the cost of qualifying additions to offset your taxable income, but you can only reduce your taxable income down to 0. If you're operating in the form of an S corporation, you get to deduct wages paid to S corp shareholders. However, for purposes of calculating the Section 179 expense, you're going to add back the wages of the S corp shareholders in determining what your call a modified taxable income. To the extent your taxable income limitation is 0 and you're not permitted any Section 179 expense, you can still depreciate the cost of those assets under the regular depreciation rules. Okay? And as you'll see, the regular depreciation rules include bonus depreciation provisions, which I'm going to get into in a little bit. So what happens if a business elects to the $500,000 maximum 179 expense, but is only permitted to deduct $300,000 because of this taxable income limitation? That's considered excess Section 179 expense, and that can be carried forward into future taxable years until it's used. However, because the current law now permits us to expense certain real property, we have to analyze what that carryover is allocable to. To the extent the excess 179 is allocable to tangible personal property, that gets carried forward into subsequent years forever until you use it. However, if the 179 expense is allocable to the qualified real property, we're only allowed to carry that into 2011. If it doesn't get used in 2011, then that excess cost is treated as if it were a new asset placed in service on January 1st, 2011, and it's depreciated under the regular rules. So we're not losing anything, it's just the timing of the expense. If the excess 179 is attributable to both tangible property and the qualified real property, that excess is going to be allocated proportionately based on the total cost of both types of assets placed in service and carried forward under the relevant rules. And just one thing to clarify, talking about excess 179 expense, and that the excess that I'm referring to is what you elect over what you're allowed, as opposed to the maximum that we're allowed to expense is $500,000. If you elect to expense more than that, that's not considered excess, and that's not subject to these carryover rules that I just went over. You actually lose the deduction, period. Okay.
And Karen, let me just make a comment, is that with these new rules about Section 179, with these different types of real property components, planning under Section 179 is being more critical than it's ever been in the past, both in terms of the real property components and how it interacts with bonus, and looking at the time horizon in 2010 when you really have pre-September 8th before the 100% bonus kicks in, from September 8th to December 31st when you could take a 100% bonus, or you could take the enhanced 179 or the real property 179. So how fixed assets are treated for tax purposes is going to be a much it's going to be a much more important topic this year than it's been in the past.
Right. Okay. So let's move on to the bonus depreciation provisions. Several years ago, the tax laws were revised to permit the write-off of a portion of the cost of certain fixed assets in a year of acquisition, provided they were placed in service during the year they were acquired. And most recently, businesses were allowed to take bonus depreciation equal to 50% of the cost of those assets. Because this is a depreciation provision, the deduction was allowed, as Vinay stated earlier, without regards. There were no limitations. So we didn't have to worry about the taxable income limitation that we have under Section 179. Before the enactment of the Small Business Jobs Act during this year, the bonus depreciation provisions had actually expired as of the end of 2009. So coming into 2010, there was no bonus depreciation. However, the Jobs Act and the 2010 Tax Relief Act that it was just passed both extended and modified these provisions through 2012. So currently, businesses are permitted to take 50% bonus depreciation on qualifying assets placed in service between January 1st, 2010 and September 8th, 2010. Then it spikes up to 100% bonus depreciation for assets placed in service between September 9th, 2010 and December 31st, 2011. So next year it's 100% bonus depreciation. And then for tax years beginning in 2012, it drops back down to 50%. So how does the bonus depreciation work? You place an asset in service, with a cost of $1,000. We get to write off 50% of it. So we get a $500 upfront deduction. We're then entitled to depreciate the balance of that asset, the balance of the cost of that asset under the regular depreciation rules. So you would have a $1,000 asset, bonus depreciation of $500. That leaves a $500 basis that gets depreciated under the regular rules. So in the year that it's placed in service, you actually could get, depending on the life of the asset, another 20% of the cost of that asset placed in service. Additionally, to the extent that the bonus depreciation is available, there's no AMT adjustment required to be computed for depreciation purposes. The AMT depreciation system is similar. It's just the lives are a little different and the percentages are a little different. But to the extent that we take bonus depreciation on assets, we are not required to compute an AMT adjustment on any of those assets.
And Karen, to interrupt you, many closely held businesses are in S corps or LLCs in which the AMT depreciation adjustment would flow through to the individual owners. So to the extent that the individual owners are an AMT, which is more often the case than not in New Jersey, then the fact that there is no AMT adjustment on the assets of the depreciation of the assets in the business is a big plus point.
Right. Okay. Obviously, just one additional point. To the extent that 100% bonus depreciation rules apply, there is no remaining basis to depreciate. so we don't even have to worry about that, for the tail end, the last quarter of 2010 and all of 2011. Now, an important point is these provisions are mandatory unless the taxpayer makes an affirmative election out of the provisions. You would have to attach a statement to your tax return, basically, saying I choose not to apply, the bonus depreciation provisions. There's some technical language. That has to be attached to your tax return. And it's not an all or nothing thing. You can pick or choose. You have to. It's done on a class-by-class basis. So it's either all 5-year property, all 7-year property, all qualified leasehold improvement property. So you can't just say, I'm not going to take bonus depreciation on this computer, but I am going to take it on that computer. Okay? So what is qualified property? It's depreciable property with a depreciable life of 20 years or less. That includes, most machinery and equipment or other tangible personal property. Most computer software, like off-the-shelf, CAM-type software is eligible for bonus depreciation. However, computer software, custom computer software that you develop yourself would not qualify. And certainly leasehold improvements. So if we go back to the Section 179 provisions, I spent some time talking about qualified leasehold improvements. Those are depreciated over 15 years, and they are eligible for bonus depreciation. Additionally, in order to qualify for the bonus depreciation, the property must be new. The use, not new to you, it basically can't be used property. It has to meet a timely placed in service requirement and a timely acquisition requirement. Basically, those two, the timely placed in service requirement and the timely acquisition requirement, deal with the existence of contracts, written binding contracts for either the acquisition and the placed in service. It has these in order to be eligible for the bonus depreciation, the property has to be placed in service before January 1st, 2013. It's extended for a year if you're dealing with aircraft or if you're producing property to be used in your business. Okay. And again, as Vinay pointed out, New Jersey and most of the states in this area do not follow these bonus depreciation provisions. Okay. With regards to automobiles, depreciation rules related to automobiles used in the trade or business are very unfavorable. The ability to depreciate cars used in your business it's ridiculous for the amount of money that we pay for cars versus the expense that we're entitled to take on an annual basis. The Code Section 280F contains the provisions limiting the depreciation expense related to luxury automobiles. And for 2010, that limit is $3,060. So that's the most that you can deduct for depreciation on an automobile in 2010. However, prior law changes, I guess, with the bonus depreciation, they did somewhat modify and allow businesses to take an additional depreciation expense, almost like a bonus depreciation expense, for the first year a car was placed in service. And that provision previously was an additional $8,000 in depreciation for the first year. And the Small Business Jobs Act extended that placed in service deadline for through 2010. So for a car that you purchased in 2010, you'll be entitled to write off $11,060 of the cost of that car for 2010. We don't get the additional $8,000 if you elect out of the bonus depreciation provisions, because this is, basically a bonus depreciation provision. And additionally, in order to qualify for this additional depreciation, the car must be new and it must be predominantly used by the taxpayer in his trade or business. If the automobile is used for both businesses and personal use, the allowable depreciation is prorated and only the business portion is deductible. So again, it's, when you're looking at leasing versus buying, lease payments on an automobile are generally 100% deductible, provided the car is used 100% for business. So you really have to do an analysis between time value of money and just the tax benefits that you'll be able to get, doing a lease versus buy analysis. And that's pretty much it for the capital investment provision. I think we've got the second polling question at this time. If you can please read the question and vote or respond.
As soon as you can. We want to get you done by lunchtime.
Okay. And now I'm going to turn it back over to Renee.
And just to follow up, and of course the answer is 500,000 on the 179. Okay, so one of the interesting things under the Small Business Jobs Act was the, hold on, my mouse is getting away from me here. Bear with me. Okay, was the ability to exclude the gain from certain small business stock, or qualified small business stock. This provision had been in the tax code for a long time, and it never really had much attention because what it was the ability for a individual who sold stock in a C corporation, may have been an S corporation too, but usually a C corporation, not to pay tax on a portion of the gain if the company was small enough. And the reason why the provision never got too much attention was because even though a portion of the gain was not subject to tax for regular tax purposes, it was subject to tax for A&T purposes. So at the end of the day, there really wasn't much of a benefit for this provision. And when you contrast it to the benefits of LLCs that allow you to pass through losses as well as gains at a single level of taxation, this provision never really took off. Well, what happened with the Small Business Jobs Act is that they enabled you to exclude up to 100% of the gain if you sold small business stock, both for regular tax purposes and A&T purposes. So now all of a sudden this has gotten a lot more attention. And some of the key things you have to know are that the stock has to be acquired after September 27, 2010, and it was part of the 2010 tax act that's being voted on today. So the tentative expiration date is January 1st, 2012. So if I'm the investor, I have to acquire the stock within that time frame. Doesn't matter when I sell it. I can sell it 10 years from now. I'm still going to get the 100% gain exclusion if the company qualifies. Some of the limitations that are not in your slides are that the gross assets of the company have to be less than $50 million, and the gain that can be excluded cannot exceed $10 million. So there's some good benefits there, but before you jump on board with this, I caution you that this only is going to work if the ultimate disposition is going to be a sale of stock. And for forming a new venture, you don't know whether you're going to be selling stock when you decide to sell your business, or you're going to be selling assets. And if you end up selling assets, being in a C corporation setting is probably the worst thing you can be in. So you have to look at the whole picture, but this is something to consider, especially if you're looking at this as from the point of view of making an investment in an ongoing business. You may want to see if you can qualify your stock under this provision so that if you do ultimately sell it again, you will be able to exclude it from tax. The S corporation built-in gain, I think we're running a little bit tight on time. I'm going to skip this. Suffice it to say that for current S corporations that elected S before 2006, they may have a tax benefit under the built-in gains provision. And if that's something that's applicable to you, please email us and we'll go through it with you in more detail. Tax credits. For 2010, there's a favorable rule for tax credits. General rule is that tax credits are carried back 1 year and carried forward 20 years, and most tax credits cannot offset the alternative minimum tax. In 2010, if you are an eligible small business, you can use credits that are generated in 2010 to offset your tentative minimum tax, which, speaking less technically, means that the credits will offset AMT. And what this means is that we have in our office a number of clients where the business, whether it be an S corporation or a LLC, would qualify for certain types of tax credits, such as the research tax credit, the energy tax credit, rehabilitation tax credit, etc., because of the work that the business is doing. But because the owners of the business are subject to the alternative minimum tax, these credits do no good. Well, in 2010, there's this 1 year window that if the credit is generated in 2010, it can be used on that owner's tax return without the AMT limitation. So that's something to think about as 2010 draws to a close and we start preparing the 2010 returns. Think about that. Are there any opportunities for credits that may have been dismissed in the past because of AMT? And that's the definition now for small business. And it really only applies to S corporations. I apologize. It's non-partnerships. Okay. Now, we're going to talk about information reporting under the Small Business Jobs Act. One of the provisions in this is, one of the revenue-raising provisions was imposing more 1099 reporting requirements. Up until now, there's been an open question. If I own rental real estate, if I have an apartment building, if somebody does work for me in the context of my owning and renting out that apartment building, do I have to send them a 1099? Because the question is am I engaged in a trade or business so that would otherwise become under those provisions? And what the rules clarify now is that, yes, I am. If I do pay somebody $600 or more in connection with managing rental real estate, I do have to send them a 1099, and it applies to payments made in 2011. So for 1099s prepared in January of 2012, you'll have to include these people. There are some exceptions, but that will be a new category of 1099s. And I do want to take just a minute to talk about, not in your slides, starting for payments made in 2012, the 1099 reporting requirements are incredibly expanded. A lot of the exceptions right now that we have for payments to corporations or payments to goods and services have been repealed by earlier legislation under the Healthcare Provision Act. And there's been a lot of uproar in the business community about how widespread these rules are. For example, under those rules that are going to come into play in 2012, if I as a business order a box of paper from Staples, I have to send Staples a 1099. It's going to change the way businesses have to record information and just how the whole information reporting process will work. Now, my guess is there's going to be some significant changes before we get to 2012, but that's just something important and it's big to keep your eye on as we get towards that due date. Jumping back to the 1099s that are part of the current act, another revenue raiser was they did increase significantly the penalties for failure to file 1099s, both on a per payment basis and the maximums that could be imposed on any one business for failure to file 1099s. And I think we have a polling question right now. Here it is on the screen. The highway landscaper during 2011 and paying $600 for services performed on rental property. You're required to give a W-2, 1099 miscellaneous, a new shovel, it is a holiday time, or nothing at all. Hopefully not too challenging a question. And okay, and I think we'll give it a few more seconds. Okay, and everybody who voted got it right. Very good.
Okay. Hiring incentives to restore Employment Act of 2009. Well, here we are at the end of 2010. Why are we talking about a 2009 Tax Act? There were a couple of payroll tax provisions under the Hire Act that will affect 2010 and 2011. So I just want to spend a little bit of time reviewing what they were. The first one deals with this payroll tax holiday. Basically, for 2010, employers were forgiven didn't have to pay the Social Security portion of tax. All right, let me start this over. The employers did not have to pay the Social Security tax on wages on certain employees that they hired during 2010. So employers who hired qualified individuals were exempt from having to pay the 6.2 Social Security tax on wages of these qualified individuals. And it's for wages paid after March 18th, 2010 through December 31st, 2010. So even, if your business is still in a hiring mode, it may make sense to question your employees, your new employees, as to whether or not they were unemployed. I'll get into what a qualified employee is. But even for, the past year, you should go back and just kind of look at any, increased headcount and try and see whether or not this is a benefit that you were entitled to. The exemption only applied to the Social Security tax. It did not apply to the Medicare tax, and also did not affect the employee portion. So remember, there's two components. There's an employer portion of the FICA tax and the employee portion. So the employees still had to have the tax withheld from their pay. It was just the employers that didn't have to pay the tax. So what is a qualified individual? It's someone who was hired after February 3rd who certifies by a signed affidavit under penalties of perjury that they weren't employed for more than 40 hours during the 60-day period ending on the date that you hired them. They can't be related, so children don't qualify, brothers, sisters, and certain other relationships. And they weren't hired to replace another employee unless that other employee separated voluntarily or was terminated for cause. Okay? Now you notice the individual has to be hired after February 3rd, but the previous slide showed that this exemption, this payroll tax holiday, only applied to tax on wages paid between March 19th. All right, so just watch out for the dates. And the second provision that I just wanted to mention is that for companies that did hire qualified workers during 2010, there's this $1,000 or up to $1,000 tax credit, the retention credit, that's available beginning in 2011. And it's for each retained worker. So basically the requirements to take advantage of this credit are the same as they were for the payroll tax holiday. The individual must have been hired after February 3rd. Additionally, they have to be employed by you or by the company for a period of not less than 52 consecutive weeks. And there's a wage requirement as well. During the last half of that 52-week period, their wages must be equal to at least 80% of what you paid them during the first 26 weeks. Right? And this is unlimited. If you have 100 qualified workers, you could potentially get up to $100,000 credit. But the credit is equal to the lesser of $1,000, or it's 6.2% of the wages paid during that 52 consecutive week period. So this is a time, since this provision came into effect during 2010, and there's a 52-week retention period, businesses aren't going to be eligible to take this credit until 2011. So it's something that you will, look at for your tax return next year. And it may make sense, like I just said, to go back and review your records. If you've done a lot of hiring, you may want to ask your employees whether or not they were unemployed and for what period of time they were unemployed, and just make sure that you're capturing everybody that you could potentially capture. Okay.
And, in contrast to the 2010 Tax Relief Act that's going to provide this holiday on the employee side of FICA,
right.
The Hire Act was to encourage employers to hire people, so it was a benefit on the employer side of FICA. So just two different things are happening in the scope of those two pieces of legislation.
And just to mention one other thing about this, in the 2010 Tax Act, the FICA reduction, the Social Security reduction, that applies to everybody, regardless of how much money you make or don't make. So everybody will benefit from that tax break.
That's right. Good point. Okay, so the last section we're going to speak on isn't so much about tax planning to save taxes, but it's tax planning to avoid penalties. As I'm sure you know, over the last few years, there's been this big scandal with Swiss bank accounts at UBS, Americans having undisclosed accounts over there, and they're all coming to light. And it's put a new spotlight over the last few years on what we in the practice called FBARs. And I don't even know the title off the top of my head, the Foreign Bank Account Reporting Form. The form was revamped about 2 years ago. It's pretty comprehensive now. In the past, it was a form that had been often ignored. They had no real teeth into it. About 2 years ago, they put real teeth into it. And that should not be new news at this point. It is, but let's just go over some of the important points about it. It is due June 30th. There's no extensions available. If the aggregate value of foreign bank accounts exceeds $10,000, you have to disclose the maximum balance in all of your foreign bank accounts. So if I have four foreign bank accounts, each of them with a $3,000 maximum balance, I have to disclose all four of them, even though no one account is over $10,000. Now, what has happened was the FBARs were really under a separate part of the Treasury. They weren't administered by the IRS. They weren't subject to normal IRS collection and penalty provisions. So there's a new form that's coming into place that's going to have to be filed starting in 2011 called the reporting of foreign financial assets. And what is a foreign financial asset? It's a financial account maintained by a foreign financial institution, any stock or security owned by a non-U.S. person, or an interest in a foreign entity. So if you have any of those three types of things and the value is in excess of $50,000, you're going to have to attach a new form, which has not been released yet by the IRS, on your tax return. So, for example, if I own stock directly in an Indian corporation and I own the stock myself, it's not held in a brokerage account, I don't have an FBAR requirement. But I will have a requirement under this new foreign financial asset form. And like the FBARs, the penalties are pretty severe for not complying with these. So this is something that needs to be on everybody's radar screen to look out for, both in terms of the FBAR and this new form. So I just want to bring that out to everybody. And I think with that, we have our last polling question. Individual with $100,000 Swiss bank account has which of the following requirements for 2011? FBAR, foreign financial asset disclosure, both A and B, or none? And we're just going to get a few more votes in, and then we'll be able to close it and send you to lunch. Okay, very good. Well, I want to thank you, everyone, for joining us. We went through a lot of detailed information, especially when it came to capital investment planning and depreciation, And I would strongly encourage you to reach out to Karen or I directly, or whoever your contact is at Wilkin Guttenplan, to go through what your individual fact pattern is, or to see if we can help you with any questions. For those of you that were taking this for CPE credit, your CPE certificate will be emailed to you. And once again, on behalf of Wilkin Guttenplan, thanks for joining us today.